It always begins the same way, with confidence. Markets are soaring, experts are smiling, headlines are shouting, "This time is different." But history has a dark habit of repeating itself, and when it does, it's ruthless. In 1929, Wall Street was unstoppable. The radio had become the internet of its time, spreading hope, speculation, and greed faster than ever before. Ordinary people borrowed money to buy stocks they didn't understand. Prices skyrocketed, fueled by debt and blind faith. And then, in October, it all fell apart. Within days, $40 billion vanished. Families lost everything. Fast forward nearly a century, and the same story is unfolding again, just with bigger numbers and shinier screens. The year is 2026, and the global economy stands on a familiar edge. Every indicator that flashed before 1929 and 2008 is flashing again. An inverted yield curve, the same one that always precedes recessions. Record debt levels, government, corporate, and personal, all three at historic highs. A housing market stretched beyond logic, and stock valuations that make even the dot-com bubble look humble. But here's the twist. This time, the world has been living inside a fantasy created by artificial money. For over a decade, central banks have printed trillions. This isn't earned wealth, it's manufactured wealth, flooding the system with cheap credit. This didn't fix the problem. It delayed it. And like a dam holding back a flood, the pressure has only built higher and higher. The parallels are haunting. In the 1920s, speculation in new technology, radios, automobiles, and electric companies drove valuations sky high. In the 2020s, it's AI, tech giants, and digital assets. Investors call it innovation. Economists call it euphoria. But history calls it the last stage before collapse. If you're watching this right now, I want you to pay close attention, because this isn't fear-mongering. This is a pattern older than the stock market itself. Every empire believes it's invincible, until it's not. In 1929, the world ignored the warnings. Margin debt tripled, insider trading flourished, and everyone thought prosperity was permanent. In 2008, the same thing happened again, just with mortgages instead of stocks. And now, in 2026, we've gone further than ever before, building an economy entirely on borrowed money, artificial growth, and digital optimism. But markets don't forgive arrogance, they punish it. By the end of this video, you'll understand why economists, historians, and even Wall Street insiders are quietly whispering one phrase behind closed doors. The next crash to be a correction. It'll be a reckoning. So before we continue, do me one favor. If you value stories that the mainstream won't tell you, hit that subscribe button, drop a like, and share this video. Because what's coming next is the kind of history that repeats when no one is paying attention. If you want to understand what's coming, you don't need a crystal ball. You just need to listen. You need to listen for the quiet whispers of disaster that always come before the storm. History doesn't repeat itself, but it certainly rhymes. And right now, the rhymes are getting louder. We've been here before. 1929, 2000, 2008. Each time, the world was convinced things were different. Each time, the same warning signs were ignored. Today, those signs aren't just flashing red, they're screaming. And if you're not paying attention, you're going to be blindsided by what comes next. Let's start with the first signal, the one that Wall Street insiders both fear and respect, the inverted yield curve. It sounds complicated, but it's really the bond market's built-in lie detector. Think of it this way. Normally, you get paid more interest for locking your money away for a longer time. A 10-year bond should pay more than a 2-year bond. It's common sense. But when that flips, when short-term interest rates actually rise above long-term ones, it's a sign of deep trouble. It means investors are losing faith in the future. They're so worried about the short term that they're willing to accept lower returns just to park their money somewhere safe, far, far away. This curve inverted in 1928, just before the Great Depression. It inverted in 2000, before the dot-com bust. It inverted again in 2006, just before the global financial crisis. And yes, you guessed it, it's been inverting on and off again, right now. Every single time this has happened in modern history, without a single exception, a major recession or crash has followed. It's not a maybe, it's a when. It's the market's way of telling us that the party is about to end, but most people are too busy dancing to notice. Then there's the second signal, a mountain so big we can no longer see the sun. Record global debt. In 1929, just before the crash, total US debt was about 250% of its gross domestic product. That was considered unsustainable then. By 2008, before the housing market imploded, that number had climbed to 350%. Terrifying, right? Well, fast forward to today. That number is now approaching 400%. Let that sink in. For every single dollar of real economic output, every car built, every service rendered, there are $4 of debt, $4 of promises waiting to be broken. This isn't just a US problem, it's a global pandemic of debt. Governments, corporations, and individuals are all leveraged to the absolute limit. We've built a global economy on a foundation of IOUs. And when the first major crack appears, when people start demanding their money back, this entire house of cards will come tumbling down. It's not a question of if, but how spectacularly it will collapse. Debt isn't wealth, it's just future consumption brought forward. We've spent tomorrow's money, and tomorrow is almost here. And that brings us to the third and perhaps most dangerous signal of all, the relentless, unprecedented printing of artificial money. After the 2008 crisis, the world's central banks had an idea. To save the system, they decided to unleash a tsunami of new money into the economy. They called it quantitative easing, a fancy term for creating money out of thin air. At first, it seemed to work. The market stabilized. But it was like a drug. The economy became addicted, and each time it got the jitters, it needed a bigger and bigger dose to calm down. Between 2020 and 2022 alone, in response to the pandemic, central banks globally printed over $25 trillion. That's a number so large it's almost meaningless. What did it do? Stocks soared to unimaginable heights. Housing prices exploded, locking out an entire generation. Cryptocurrencies went to the moon. Everyone who owned assets felt incredibly rich. But it wasn't real wealth. It was an illusion, a grand spectacle fueled by borrowed time and fake money. And here's where the real danger lies. When money is too easy for too long, it loses its meaning. Risk becomes an abstract concept. People forget what financial pain feels like. They start making reckless decisions, buying things they can't afford, investing in things they don't understand, all because they believe the numbers will only ever go up. This is exactly what happened in the Roaring '20s. Just like today, new technologies and easy credit created a sense of permanent prosperity. Back then, economist Roger Babson was one of the few voices of reason. In 1929, he stood before a crowd of confident investors and warned, "Sooner or later, a crash is coming, and it may be terrific." He was mocked. He was called a pessimist. The party was too good to end. Months later, Black Tuesday hit, and the world plunged into the Great Depression. Babson wasn't a fortune teller. He was just reading the signs. The same pattern repeated in the mid-2000s. A handful of analysts like Michael Burry and Nouriel Roubini started warning about the subprime mortgage bubble. They saw the fraud, the insane leverage, the undeniable signs that the housing market was built on a lie. And what happened? They were laughed at. They were dismissed as cranks, out of touch with the new paradigm of real estate. They were told that housing prices never go down nationwide. They were laughed at right up until the moment Lehman Brothers collapsed in 2008, triggering a financial meltdown that nearly destroyed the global economy. Their warnings were drowned out by the chorus of greed and optimism. And today, history is rhyming once again. The same kind of warnings are being issued by a new generation of dissenters. But this time, they're not just warning about one bubble. They're warning about the everything bubble. A crisis that won't just hit one market, but every market simultaneously. Stocks, bonds, real estate, crypto, even the currencies we use every day. Every single data point screams fragility. Corporate profits, the engine of the stock market, are shrinking. The savings that people built up during the pandemic? Gone. Personal savings rates are at historic lows. At the same time, credit card delinquencies are surging. People are falling behind on their payments at a rate we haven't seen in over a decade. And all the while, stubborn inflation is acting like a hidden tax, eating away at the value of every paycheck. Your money buys less and less each month. Yet, despite all of this, the illusion of prosperity continues. We look at our phones, we see the stock market tickers, we read the headlines proclaiming, The market is strong, but it's not strong. It's stretched. It's brittle. It's like a rubber band pulled to its absolute limit, just waiting for the slightest nudge to snap. We've seen this movie before, and we know how it ends. Think about the psychology of each major crash. 1929 was defined by greed, an insatiable, blind greed that believed the sky was the limit. 2008 was defined by ignorance, a willful ignorance of the complex and fraudulent financial products that were poisoning the system from within. And the coming crisis? It will be defined by denial, a collective global denial that this massive, debt-fueled party could ever possibly end. And on Wall Street and in life, denial is always the most expensive emotion. It's the refusal to see what's right in front of you, simply because you don't want it to be true. So when the crash finally comes, and make no mistake, it will. It won't look like a single dramatic event on a single day. It will happen slowly, and then all at once. First, you'll see the cracks spread. Banks, spooked by rising defaults, will suddenly tighten their lending standards. The river of easy credit that has fueled the economy for over a decade will dry up overnight. Liquidity will vanish. Companies that only survived by borrowing more and more money to pay off their old debts will suddenly find they can't. They will collapse under the weight of their own obligations, triggering a wave of layoffs. And the panic will spread. It will jump from country to country, from market to market. Because this time, unlike 2008, there is no untouched corner of the world economy left. Everyone is connected. Everyone is exposed. There's no bailout big enough to stop it, because the problem isn't a few bad banks, it's the entire system. So ask yourself this simple, crucial question. If every great financial crash in history has been preceded by the exact same signs, an inverted yield curve, unsustainable debt levels, and a speculative mania fueled by easy money, why does everyone keep pretending they don't exist this time? Why do we collectively choose to believe the comforting lies over the uncomfortable truth? The signs are not hidden. They are in plain sight for anyone who is willing to look. The choice is whether to pay attention now or to pay the price later. Ever noticed how every big financial disaster seems to follow the same script? It's a 7-act play, and we've seen it time and time again. It starts with a boom, a period of incredible growth and optimism. Then comes euphoria, where everyone thinks the good times will last forever and that they're a genius for being in the market. This is the stage where caution is thrown to the wind. But then, the cracks start to show. The first signs of trouble appear, but most people ignore them. This is the denial phase. They say, this time is different. The party can't possibly end. But it always does. The denial gives way to panic as reality sets in and everyone rushes for the exits at once. And then, the collapse. The bottom falls out, fortunes are wiped out, and the music stops. After the dust settles, the blame game begins. Who's responsible? The bankers? The regulators? The politicians? And finally, after all the finger-pointing, we get reform. New rules are put in place to prevent it from ever happening again. Boom, euphoria, denial, panic, collapse, blame, reform. It's a predictable cycle. And here's the scary part. Right now, we're in the denial stage. The stage just before the panic. Governments know it, the big banks know it, even the Federal Reserve, the institution tasked with maintaining stability, knows it. But they're all caught in a trap of their own making. They can't publicly admit the system is fundamentally broken, because doing so would trigger the very panic they're trying to avoid. They're stuck between a rock and a hard place. Think about it. If they raise interest rates aggressively to combat the inflation that's eating away at our savings, they risk crushing economic growth and sending the markets into a tailspin. Businesses would stop borrowing, hiring would freeze, and a recession would become almost inevitable. But if they cut rates to prop up the markets and keep the economy humming, they risk reigniting inflation, making the cost of living even more unbearable. It's a classic catch-22. No matter which lever they pull, chaos seems to be the likely outcome. This isn't a new story. History is littered with examples. Back in 1929, the bubble was fueled by excessive margin debt and wild speculation. Everyday people were borrowing money they didn't have to bet on stocks they didn't understand. We all know how that ended. Fast forward to 2008. The culprits were different, but the theme was the same. This time, it was subprime mortgage fraud and complex toxic derivatives that nobody truly understood. The entire global financial system was built on a house of cards, and when it came toppled, it took the world economy down with it. So, what's the fuel for the next potential crisis? The one some are calling the 2026 collapse. It's over-leverage, but on a scale we've never seen before. It's everywhere. It's in corporations borrowing billions not to invest in new factories or research, but to buy back their own stock to artificially inflate share prices. It's in the crypto markets, where speculation has reached fever-pitch levels with little underlying value. And it's in our governments, running trillion-dollar deficits year after year, piling up mountains of debt that seem impossible to repay. The entire financial system has become a massive echo chamber. Everyone is listening to the same experts, following the same trends, and chasing the same hot stocks. There's a widespread belief, a dangerous delusion, that we'll all be smart enough, quick enough, to get out just before the music stops. But that's never how it works. History shows us that the exits are always far, far smaller than the crowd trying to squeeze through them. When the panic starts, there's no time to think. There's only time to react, and by then, it's usually too late. But here's the thing. In the rubble of every collapse, there are powerful lessons to be found, if we're willing to look for them. The Great Depression taught our grandparents a brutal lesson. Markets can erase generations of wealth in a matter of weeks. It taught us that buy and hold isn't always a winning strategy, especially when the foundation is rotten. The 2008 crash was a stark reminder that no institution is too big to fail. We watched in disbelief as giants of Wall Street like Lehman Brothers vanished overnight, proving that even the most supposedly secure pillars of the financial world can crumble. The next crash, the potential 2026 collapse, will teach us a lesson that's perhaps even more profound. It will teach us that when money becomes limitless, when central banks can print it into existence with a few keystrokes, it eventually becomes worthless. The very definition of value gets eroded. When there are no consequences for debt and no limits on money creation, the entire system loses its anchor to reality. Now, I want to be clear. This isn't a doomsday prophecy. I'm not here to tell you to sell all your possessions and hide in a bunker. This is a wake-up call. It's about understanding the environment we're in. History isn't repeating itself by accident. It's rhyming, as Mark Twain famously said, because we, as a society, have failed to learn the lessons from the past. We patch up the system after each crisis, but we never address the root causes. We treat the symptoms, not the disease. So as you go about your day, as you watch the news, and see your account balances, I want you to remember this. In the world of finance, knowledge is protection. Understanding these cycles isn't about being a pessimist or spreading fear. It's about survival. It's about being prepared, not scared. When you hear the experts on TV with their perfect suits and confident smiles telling you that the economy is strong and the fundamentals are sound, I urge you to look deeper. Ask questions. What are they not telling you? What data are they choosing to ignore? When you see the stock market hitting new record highs day after day, take a moment and ask yourself, what is actually fueling this? Is it genuine economic growth, innovation, and productivity? Or is it fueled by cheap debt, financial engineering, and speculative fever? Because here's the honest truth. Bubbles don't announce themselves with a flashing sign that says, "Warning, bubble." They seduce you. They whisper in your ear that you're a genius, that this time is different, that you've discovered the secret to easy wealth. They make you feel foolish for sitting on the sidelines. They thrive on FOMO, the fear of missing out. The crash of 2026 isn't a certainty. It's not written in stone. But it is a very real possibility. And every major sign, from the debt levels to the asset valuations to the behavior of central banks, suggests that it's closer than most people are willing to admit. We're seeing the same patterns, hearing the same justifications, and feeling the same euphoric sentiment that preceded every major crash in history. Remember that famous quote, "History doesn't repeat, but it often rhymes." And if you listen closely, you can hear the rhyme right now. It's the sound of a system stretched to its absolute limit. It's the sound of a bubble getting bigger and bigger, searching for a pin. It's the sound of a market breaking. The more you understand this, the better you can navigate what's to come. Thanks for watching. Don't forget to like this video and subscribe for more insights to help you stay ahead of the curve.